While the stock market is rallying 20% in 3 days, it remains to be seen how many unemployed will be back to work anytime soon. The $2 trillion bailout has already been deemed too small. So, the hardworking people of government are already preparing for the second round. Another $2 trillion will do the trick? Maybe $4 trillion. Why not a helicopter drop to save time? You came here for the truth, so let me unveil that for you. Today we're going to look into what's going on. I'm going to talk about the biggest shock ever. I'm going to show you some details you need to know. I'll keep it quick. Let's move into it. Markets take 3 million claims in stride and now brace for a tsunami of negative news. You probably already heard these details, but Thursday's report that a record 3.28 million people sought unemployment benefits was met by relief in the markets that the number was not far worse. Think about how ridiculous that is. Well, it wasn't 300 million people, so therefore it's okay. No, look at the data. Look at it objectively. Look at it historically. When you see every single time you look at the chart, jobless claims coming down in good times, they spike up during recessions. It's the same pattern over and over again. These were coming down to record lows. Everything was totally fine. Everything was fantastic. The number of 3.28 million was so large compared to all of the previous instances that when you look at it on the chart now, it's basically a flat line and then a hockey stick formation upward. There's these little blips along the way, but you can barely even see it because this has gone to a level so far beyond anything we've ever seen before. They got their 2 trillion in their whole ridiculous stimulus bill. That wasn't enough. Immediately the governor said, what is this? This isn't enough. They're going to have to go to 4 trillion. They're going to have to go to 6 trillion. Who knows where it's going to stop? But that's the government. That's one side of it. The Federal Reserve's balance sheet has now escalated to approximately $5.3 trillion. I talked about this in my previous video. We've gone into ridiculous levels today on all fronts. On all fronts, they have done this, and every government and every central bank is full pedal to the metal right now. Ford warns of potential job cuts and will partially defer executive salaries. I think GM is also cutting salaries. What I wanted to show you with this is that these industries are hit. They're hit hard. If they're not producing cars, if they're not making stuff, how long can they keep these people on the payroll? Okay, if it goes on for a couple weeks, maybe it's not such a big deal. A month, sure they can handle it. But this starts to go for a long period, and these companies have to start saying, well, maybe we don't need so many people. Maybe we could shut a few of those factories. And the economic impact is felt far beyond anything that the government can fix by throwing 2 trillion, 4 trillion, 6 trillion, whatever it is. The government is trying to provide a crutch when everything is falling down. They're trying to be there to stop it, keep it at this level, and then hopefully everything's going to turn up again, and they can do this with minimal dollars invested. That's their intention. But as you can see, what actually happens is that the problem gets worse. There usually is a relief rally that takes place. Some might want to call that the dead cat bounce. We'll all see it in time. Usually there's this huge fall that takes place. Everybody's freaking out. There's buy the dips happening along this way and everything is falling terribly. And then at some point, somebody decides to ramp up the printing presses, get everything going, things get pumped back up. As we have seen in many cases, historically, this is the most likely scenario that it falls further than where it was before. This is all based on the technical analysis. What we have going on fundamentally here is a lot bigger than just technicals, so we only know as this evolves. The problem extends much further than Ford and GM and the car companies and the airlines and so on. It's affecting every single industry right now. My whole point here is that you can't fix it by papering over it. Mortgage firms brace for wave of missed payments. Now, what do you think this is going to do to these banks, to these lending institutions? As you have this rising, even if it's a moderate amount, of course, that's going to have an impact on the bottom line for these companies. There are always going to be people who miss their payments. This is baked in. But when the numbers start to become unreasonable, you start to have the unraveling of the derivatives. It isn't the problem, as I said, when it's just a few people. But as those numbers grow, you start to have it become more and more of an issue. This is going to affect the auto sector, it's going to affect housing, everything in between. This article was from a while ago, but I wanted to talk about this subject. People live paycheck to paycheck, and there isn't much room left over at the end. I've heard different numbers, different studies, but for so many people, anywhere between $200 to $400 is enough to break them. If they have an unforeseen expense at about $200 to $400, their whole life is thrown upside down. The data that I have so far shows that we are in big trouble today because they've lost work. People have lost work for just a few weeks, and already they're using their credit cards. They're going into debt. This is an extremely dangerous thing to happen because, of course, you're looking at about 17% interest rates despite the fact the Federal Reserve dropped them to zero. Credit card companies still charging approximately 17%. That might come down a bit, but it's still going to be excessively high. The government is going to give people $1,200 with the potential for more coming along. So let's just say a few $1,000s. That's great for a short period of time, but you can't actually fix problems by giving people this amount of money. It's not going to resolve any issue that they have. It's the same with the Federal Reserve, how they are basically bailing out all of the different bonds out there, thinking that that's going to fix the problem. Well, of course, when you look into it deeper, you realize that's not what they're doing. They're trying to actually take over all of the markets. They're trying to consume everything and eventually be able to buy all assets. But that's a whole different story. What we're looking at right here just shows you how people are right at the very edge. Everything is fine and fantastic until something comes around and swipes them off their feet. The average American now spends nearly $800 a month on their car. To me, this is absurd. This is the average American. Now, I don't know all the numbers, I don't know all the details, but I just wanted to show you this because of how high people's expenses are. They think to themselves, okay, well, my mortgage is $1,200, you have my car payment at $800, that's $2,000, okay, and then I add in my food and all these expenses, and it comes up to, let's just say, $4,000. Okay, $4,000 a month, fine. And I make, let's say, $4,500 a month. Okay, great. I have $500 a month left over, and I'll save a little bit of it, and I'll put some, I'll spend a little bit, and I'll put a little bit here and there. Everything is fine. But suddenly something comes around and swipes out one of those factors where the income is coming in, or maybe the expenses go up dramatically. Suddenly this $500, maybe it gets taken out entirely. Maybe it gets reduced down to dangerous levels. Maybe now that people have to go spending on their credit cards just to be able to pay the bills. Then you have that cascading effect. Suddenly they are claiming bankruptcy, they're not paying back their debt, the company takes a hit, the derivatives start to fail, the financial system starts to unravel. And I wanted to finish with this. We're talking about pensions. The pot of invested money used to pay for hundreds of thousands of California public employee pensions has shrunk by $69 billion as the markets have fallen. Now you're seeing that they have come up definitely since the lowest point, but the point remains. People rely so heavily on their pensions, and it has already been detailed by the former governor of California. Next recession, they have to cut the pensions. There have been so many examples that I have shown you here on this channel before related to people's pensions, how they have already slashed them, and the average I have seen in my examples that I've shown on this is 30%. Can you or the person you know that relies on a pension be able to deal with a 30% haircut, and meanwhile inflation is picking up? That's a double whammy right there, but it's coming. Whether or not it's coming now or it's coming in a few years, it's coming. The pensions in the United States are bankrupt. Illinois is just one example. Look around. For the most part, they're all heavily underfunded, or I would call them bankrupt, and others are not as bad. But in a market rout, you see the failure of this system where we had an 11-year bull market and somehow still they're falling under where they're promised to be paying back. It's absurd. The amount of distressed debt in the US has quadrupled in less than a week to nearly $1 trillion, reaching levels not seen since 2008, as the collapse of oil prices and the fall off in the situation going on shudders the entire industries across the globe. If the situation isn't handled, the worst is yet to come. We're looking at a very big problem right now that, yes, if this is dealt with rapidly, you could certainly see that V-shaped recovery. But to me, this is senseless because along the way, there are going to be problems. There are going to be issues, and we know exactly what they are. It's not as if it's going to come out of left field anymore. We know the data, we're getting it daily, and we can see the problem in front of our eyes. This causes issues all down the line. One industry starts shutting down, they close their doors, that person's out of work, that puts a burden on something else, they're not buying this or that. That industry starts to feel it, and it happens rather rapidly. Sudden surge, amount of distressed bonds surges to the highest since April of 2009. You can see it here in this chart out of Bloomberg. Well, I'm going to end the video there. If you found it informative, hit that thumbs up button. When you do, you're supporting this channel. If you want details from me that are not available elsewhere, I cover that stuff on Twitter and on Instagram every single day. They're actually growing a lot. I want to thank all of those people for joining me on there. Check me out at The Money GPS. If you are interested in learning how to sell online, I have this free e-course that teaches you everything you need to know. It's available at the AmazonGPS.com. Hey now, are you interested in the financial system and how it works? How about making money? How about all the details, top to bottom? I cover it all in these 2 books. Check it out at the link in the description if you want the audiobook instead, themoneygps.com. 47,000 stores are closing, but how many will reopen? Check out this video.